Thank you. We're very pleased and lucky to have as our last speaker Roger Ferguson. Roger served since April 2008 as President and CEO of the Teachers Insurance and Annuity Association College Retirement Equities Fund, or TIAA-CREF. From 1981 to 84, Roger was an attorney at the New York City office of Davis Polk and Wardwell. He became a partner of McKinsey & Company based in New York from 1984 to 1997, where he managed a variety of studies for financial institutions. He also served as Director of Research and Information Systems, overseeing a staff of 400 research professionals. He and I overlapped at McKinsey, although I don't think we ever met in person at that time. From November 1997 until October 1999, he served as a member of the Board of Governors of the Federal Reserve System, and in October 1999, he became the Vice Chairman of the Federal Reserve. Please welcome Roger Ferguson. Thank you.
Martin, thank you very, very much for that kind introduction, and it is my pleasure to be here at the Brookings Institution. I think it was last year, about a month ago, where we were talking about low interest rates and other things, so it's a pleasure to be back talking about equities. I'm going to focus my attention today on retirement, and that's for two reasons. One is retirement and retirement savings are clearly heavily intertwined with the equity markets, obviously, as was already discussed. And secondly, this happens to be National Retirement Planning Week, so the timing is apt. And I should say the obvious third reason, which is TIAA is a very large player in the retirement sector, particularly in the not-for-profit space and the 403B space. I would also say, all of a note, this week, TIAA announced the findings of a study that we conducted of our retirees that I think may shed some light on retirement security, and interactions with equities. This is a follow-up to some research that we did about 30 years ago. So I'm going to say a bit more about that study later, which we call the Voices of Experience. There's a spoiler alert about the Voices of Experience study, by the way, which is that despite all the current anxiety that surrounds retirement, maybe appropriately for many people, what we found when we surveyed the TI participants is that their degree of safety and security and satisfaction in retirement is remarkably high. And I think that intersects with some of the topics that have already been discussed. So with that news as backdrop and that spoiler alert, my talk is going to be around three things today. First, I'm going to outline some of the challenges that we face around retirement in the U.S. This will be stage setting. For many, this may be repeat. For some, it may be new. Then I'm going to discuss what we've learned at my company and others over the last 98 years about creating financial security and appropriate use of equities, obviously, in that space. And then I'm going to talk about some policy solutions that we believe are important to addressing these challenges, and in some sense making the equity markets and the use of equities as part of a retirement tool may be more useful. So first, and this is sort of, Susan is here, at McKinsey we used to describe, you want to set up the situation, then the complication and the solution. So for those who are McKinsey aficionados, this is the situation and complication part of the speech. So the retirement story in the U.S., as you know, is one in which we face many challenges driven by three factors. First, the lack of adequate savings by individuals. Secondly, the decline in traditional pension plans in the private sector. And then third, the aging of the population, which should be a positive thing as lifespans increase and birth rates fall, but there's a negative component, which is that it leaves fewer workers to support aging baby boom populations around the world. A lot of folks would say, well, gee, the financial crisis is the thing that really started to drive us towards a period of insecurity around retirement. In fact, that is not true. The financial crisis and the Great Recession only exacerbated the trends that pre-existed that period that were already showing us and creating some threats and stresses in the retirement outcome. So to understand a little bit of the degree of the challenge that we're confronting, the Federal Reserve, where I used to work, has estimated that fully 1/3 of Americans have saved nothing at all, literally nothing for retirement, hard to imagine. Only 1/5 of Americans say that they are, quote, very confident about having enough money for a comfortable retirement, and that's even as many are going to be living, because of longevity, longer periods of time in so-called retirement. To give a little sense of what that means, the average life expectancy in the U.S. has hit an all-time high of nearly 79 years. overall. But importantly, for those who are already 65 today, they're likely to live much longer, to about 85 for women or 83 for men. Within our client base, TI, we know that for married participants who reach 65, there's a 45% chance that at least one spouse will make it to 90. We serve a slightly more highly educated population than the average. I'm not suggesting that people at Brookings have easier lives or anything of that sort. It's just that they're much smarter and take better care of themselves. So the truth is that lifespans have been rising broadly, and in fact, they have been rising disproportionately high for individuals who have high education, which is not in any sense a joking matter because it says something about some other challenges in society. At the same time that lifespans have risen in the U.S., the birth rate has fallen. So now we have about 2.1 births per woman. For those who don't know the statistics, at the height of the baby boom, if we're now at 2.1 births per woman, at the height of the baby boom, that number was around 4. And so birth rates have come off quite dramatically in the U.S. And so what these two trends have combined to create is a steadily aging population. And it's predicted that the elderly will make up nearly 22% of the U.S. population by 2040. What does all this mean? Well, one, I think, has already come up, which is that this will create some great strains on Social Security. Whereas in 1950 there were 16 or 17 workers per each retiree, today there are only about 2.8 workers per retiree, and then it's forecast to drop to 2 to 1 in the next few decades. So what this really means is that one of the biggest challenges for individuals is that today, like it or not, and most do not like it, we are bearing more and more responsibility for ensuring our own individual retirement security as Social Security and other things come under more and more threat. I think this came up a little bit in the earlier panel. I know my friend Josh Godbaum from his PBGC days is really expert in this. One of the other things that's changed is that most of us used to be able to rely on company pensions, also known as defined benefit plans. In 1980, 62% of private sector workers relied solely on the company pension for their retirement income. By 2013, that share had risen to about 17%. So the company pension used to be the bedrock fallback for literally 2/3 of Americans. In fact, their only approach. Now that's down to less than 20%. So what has happened? What's happened? I think it came from an earlier panel. Today, the 401k and other defined contribution plans dominate in the private sector. In fact, a few years ago in 2013, 71% of private sector employees relied on these plans as their core retirement savings vehicle. The problem with all of this shift from, to some degree, the private sector in the form of DB to DC and some uncertainty around Social Security, is that far too many people lack the financial knowledge that they need to make the kinds of savings and equity investments or other investment choices that now have been placed squarely on their shoulders. There's a famous book around this by a Yale economist called The Risk Shift, and that's really what we're talking about here. Studies have clearly identified a widespread lack of financial literacy in the U.S., and this has serious implications for retirement readiness and for the ability to use equity markets, for example, as a retirement tool. So what does all this mean? Well, we know that people with a high degree of financial literacy are more likely to plan for retirement, and those who plan for retirement are more likely to accumulate the wealth required to retire. In fact, people who plan for retirement have more than double the wealth of people who do not plan. And conversely, people with a lower degree of financial literacy tend to do a number of things that put their financial state at risk. They tend to borrow more, they tend to accumulate less wealth, and then they tend to select investments with higher fees, which obviously links into the way equity markets perform. Interestingly, those with a lower level of financial literacy are less likely to invest in stocks. They're more likely to experience difficulty in debt, and they're even less likely to know the terms of their mortgages or other loans. And so you can see that there's really a bit of a witch's brew developing out there. And it's quite clear, there's ample evidence that the current model is just simply not getting the job done in terms of adequately preparing workers for financially secure retirement. Some statistics, over 67 million Americans lack access to a retirement plan at work. Of those who do have a plan, many choose not to participate. And even when employees do participate in workplace plans, they and their employers often don't contribute enough to their investment accounts. Other challenges in this space: many employees don't implement an appropriate asset allocation strategy for investments, and many get fixated, I'd say overly fixated, on the size of the account balance, the accumulation process, without considering the most important thing, which is the income flow that they'll need in retirement. And finally, many fail to preserve assets for retirement, i.e. there's much too much leakage, as retirement economists would call it. So for those who are still with me and enthused about the opportunities in front of us, what I've clearly done now is pointed out how complex the retirement situation is, how we've moved risk from to individuals from institutions, and obviously how that plays into equity markets will become more obvious as we go forward here. So let me now turn my attention to the solution part of the story. If I've set up the situation and the complication, what's the solution? I think, back to what I said earlier, there actually are some models that seem to work in the private sector. One is TIAA. I'm not here to sort of advertise a company, but just to talk about a model. So I talked about the Voice of Experience study that we did earlier. We surveyed 1,600 of our retired plan participants, and we're delighted to find that 93% of them said they were satisfied with their retirement. And that's the same result as we got 30 years ago. So if you think about where the country was 30 years ago, around a general sense of security versus where we are now around a general sense of insecurity, it's interesting to see that there are ways that one can maintain a pretty high level of sense of security around retirement if you do it the right way. So one of the things that's important that we've learned is it's important to start by planning for retirement early in life. And even the majority of those who started planning after the age of 50 consider themselves satisfied with retirement. So a simple message here is it's never too early to start thinking about retirement and the appropriate set of investments. But in some sense, even if you start at the age of 50, given what longevity looks like, that's also a good thing. And so we shouldn't discourage people. I think we sort of give a sense to folks that, gee, if you don't start thinking about retirement when you're 25 or 30, you're lost. You're better off if you do it at the age of 25 or 30, but if you start thinking about it seriously at the age of 50, that's also a useful thing to do. The other thing that we learned from our study is that plan participants, surprisingly enough, are retiring earlier than they had planned. This is a real surprise to us, right? Because we are thinking about reluctant retirees, people not having enough to retire, delaying retirement. So we went out and surveyed these 1,600 people. Over 70% had expected to work until the age of 65, but it turns out that only 47% actually did that, and they retired of their own choice in most of those cases. My phone is going off and embarrassing people in the front. It's one of our retirees calling to cheer us on. So let me then describe a little bit about the model so that we can look at what a really good system looks like and, again, figure out ways that we might emulate this across society. While there are differences, I'm going to just talk about the commonalities across these various models that have gotten people to this place where they're feeling more secure about retirement. One of them, very important, is the mandatory employee participation. I talked earlier about the number of folks who, one, don't have plans, but two, who don't participate. And I think Woody Allen once said, or someone once said, the most important part about life is short of showing up. The most important part about getting ready for retirement is actually participate in the program that is available to you. And it's a big challenge, obviously, but it's really a simple and easy lesson. The other thing is, particularly here where we're talking about equities, is to have the appropriate mix of investment options. I'll come back and talk about that a little bit. A third component of a really good plan is to make it a joint responsibility between employer and employee. So in our case, our institutions almost all contribute to the retirement savings. And then something that is a little more controversial but very important is to think about your retirement plan, not just around the investment side, but the so-called decumulation side, having a component of the plan that looks like a historic DB or the private sector equivalent, which is an annuity. And I know in this room, perhaps people's ears perk up and say, annuities, my goodness, we thought those weren't such good things. I think the truth of the matter is a well-structured annuity, appropriately priced, without embedded options and unrealistic guarantees, really is pivotal. because that is the way one guarantees income for life. And just as most of you undoubtedly have insurance on your homes or insurance on a car or insurance should you die prematurely, an annuity is just simply a way of providing insurance in case you are blessed with an unexpectedly long lifestyle. And so one should think about annuities in that context and really take some time to understand them. And then the final structural element here that will come into play a little later in my talk is the folks tended to have access to education and advice to help them make these decisions. So a real recognition that the investment decisions associated with anything, but certainly with retirement, are pretty tricky and complicated, and therefore having objective advice is very important. So what does all this end up with? Well, we estimate that part of the reason this group of 1,600 folks was so pleased, and this is true across all the programs that we administer, is that we have in our plans about a 90% income replacement ratio, which is to say that people in retirement in these plans are going to be able to replace about 90% of the income they had during their earning years, which is really quite a strong statement, given that most people think in order to have a good retirement, you probably need to replace 75 to 80% of your income. So now let me drill down to the thing that brings us all together here, which is the role that equities play in this approach. And the answer, just to go straight to the headline, is equities are a pivotal part of the approach, which is why this kind of conference is so important. When you heard Martin mention the name of the company, it's a pretty long mouthful, TIAA and CREF. We've now recently shortened it back to TIAA. When we originally started, the TIAA part of the company was the insurance and annuity part of the organization. By the way, we were started in 1918, so we predate Social Security by about 35 years. Importantly, though, and this is where the equity story comes into play, in 1952, we created the second big product of the company, which is the College Retirement Equity Fund, CREF. This was a phenomenal insight that, in fact, in order to deal with both longevity, to deal with inflation, and frankly, to potentially create, well, third, diversification, and then fourth, potentially better returns over a period of time with risk, it was important to include equities in a well-balanced retirement program. So what's happened with that? 6 decades later, our CREF stock account, it remains professionally managed, low-cost way to add this diversification, and it's grown from literally zero to $230 billion, thereby, I think, validating the importance of equities. The other point I'd make, though, is that it's not just an accumulation vehicle. So if one is thinking about equities in retirement, we tend to think about it as the accumulation vehicle. The magic, or one of the magical parts about CREF is it actually underlies a variable annuity. So it links very much into a retirement thinking. And I think this is an important theme here, because as you're talking about equities as an investment tool for retirement, one is to then ask, well, what happens to it once you get to retirement? And an answer, one that seems to work pretty well in the retirement space, is to use that pool of equities to create a variable annuity option that then allows you to have, again, income that goes up and down, admittedly, with markets, but is there for those special needs when markets are good, and perhaps you use less of it when markets aren't so good. Now, obviously, since the creation of CREF in 1952, we and others have added mutual funds, IRAs, and life cycle funds as equity-based ways to save for retirement as well. They are clearly also a very important asset accumulation vehicle for millions of Americans. And so we recognize the importance of those, but we don't step back from the importance of both a fixed annuity and a variable annuity. Let me move on to talk just a moment about annuitization, and then talk a bit more about policies as they exist today, and then open up for questions. So on the annuitization story, both fixed and variable, it turns out that very few Americans really understand the value of buying that insurance policy for longevity. It seems odd in some ways, because we all understand the importance of buying insurance for other things. But only about 6% of Americans, according to the GAO, in a defined contribution plan, either chose or purchased an annuity at retirement. Obviously, for our company, given that we're a retirement-oriented company, that number is much higher, and it turns out that about 70% of retirees who work with us have a fixed or variable annuity, and 92% are very satisfied with that choice. So I think this is another very important theme about what do you do once you gather this pool of equity investments, how do you use them when you get to retirement? And creating an annuitization option, I think, is an important part of it. Let me close by just saying a few words about the current policy situation. I heard some discussion of the fiduciary rule on the prior panel. I'm going to put that in as well as a few others. One of the first issues that I've already hinted at that we should be more explicit about in terms of policy prescriptions is around this lifetime income challenge, i.e. the ability to get more people to share the risk of longevity with a big professional risk management company, such as an insurance company. And we think that as part of the story of good retirement security, that a good equity portfolio, a good equity choice should also include a lifetime income option in the plan. So many workers today, not as many as we would like, but many are automatically enrolled in their employees' retirement plans. They accumulate often in the default, which tends to be a life cycle fund or a target date fund, again, very equity driven. This automatic revolution, this automatic enrollment has also been joined recently by another positive thing, which is automatic escalation. So these are some very good positive things, but the challenge that I think we see is with most folks defaulting into, let's say, the target date fund or life cycle fund, they're not quite getting what they expect to get. What they are getting is a good equity-based program with a glide path that reflects when they are likely to retire, moving from equity to fixed income, for example. But what they don't get is what they often expect, which is lifetime income features. So when you survey people about target date funds, more than 80% of them think that what they're going to get is not just a good equity investment, but also a way to get guaranteed income for life. In fact, that's not included in target date funds today, mostly speaking. And so this is policy challenge number one, which is how to respond to what people think they're getting in target date funds by having in the funds themselves a lifetime income option. And one of the things that could happen here is the Department of Labor might be able to modify its rules that govern these plans, so-called qualified default investment alternatives, QDIA plans, which are primarily these target date funds or life cycle funds. And we would certainly like to see the department enable some default options that include lifetime income features. The department's QDIA rules, again, the Qualified Default Investment Alternative rules, were put in place following the enactment of the Pension Protection Act a few years ago to ensure that employees, and again, remember, most employees do default, so employees who default in retirement have diversified investments. That's a great idea, but we think that they need to take one step further around the rules to allow for a lifetime income option. So we think revising the QDIA rules to embed income options would be a very good policy step forward. Another idea in which policy can make a difference is in access to retirement plans. Every worker, we think, should have an opportunity to save for retirement at work. It's clear that people are far more likely to save for retirement at work than on their own. And so a new idea that's starting to emerge that we think is a good idea is the state-level secure choice initiative, which would establish state-administered payroll deduction IRA arrangements for workers whose employers do not offer a retirement plan. We think this secure choice approach is just a start, but it's an important one, and it's one that we think could help enhance the opportunities for workplace savings. And then a final point I'd like to make is about something that came up earlier, which is the DRL's recently announced fiduciary investment rule. We support this rule. We think it significantly and appropriately expands ERISA's definition of fiduciary investment advice, which we think is a net good thing for savers and ultimately for the industry. And I heard a range of comments at the front here, so I just want to make clear that you've heard me say that we at my company really do support this rule. We think it's the right thing to do. Putting the customer first has always been a core value that defines the way we work. It's an important part of what we include even as we think about retirement plans and IRA owners now. And we applaud the department for pushing to make this an industry standard. We also applaud them, obviously, for listening to industry concerns and modifying the rule in ways that has made it much more workable. We think one of the most important aspects of this rule relates to the IRA rollovers. And IRAs are a key part of creating retirement security, so we strongly agree with the Department of Labor that individualized distribution advice, including whether to roll over, should be subject to the same fiduciary standard as all other investment advice. We think this will ensure that rollover discussions, including whether to roll over from an employer-sponsored plan to an IRA, are always in the employees' and the retirees' best interest, which is, to us, pivotal. This is going to have important implications for retirement securities. IRA assets grew from about $2.6 trillion in 2000 to $7.6 trillion in 2015. So they now eclipse retirement plan assets. And this growth has been really largely driven by rollovers out of plans into IRAs. In fact, 93% of contributions are not new monies. 93% of IRA contributions are not new monies at all, but rather roll-ins from retirement plans or other IRAs. And it's pretty clear that the amount rolling into IRAs will continue to grow. It's projected to reach about $550 billion by 2018. So subjecting a rollover advice to a fiduciary standard, we think, will help protect participants from potentially harmful practices. We think it's an important way to help more Americans build financial well-being, and we think it's an important way to create a higher degree of trust and confidence between providers of financial services and individuals. So let me close by reiterating what I've shared today. I started with a fairly dire statement around the situation that we face in the retirement world. Our nation faces many challenges around retirement. Our population is aging. Individuals are becoming much more responsible for their retirement savings and other savings. The second point I made is there is actually some good news, which is we know how, as a society, to build retirement security. It includes a number of features that I've talked about, but the good news is that they do exist. And the third point I made is that policymakers have an important role to play in helping achieve many of these goals and challenges, particularly related to lifetime income, related to coverage, and importantly, as I just did, related to making sure that the industry puts individuals' interests first. So with that, thank you very much for listening, and I look forward to the Q&A session. Thank you very much. Sure. Absolutely. Do I need a mic, or will we?
No, there's a mic there, and we'll have someone come on.
Oh, that's all right. I can manage. Can I use this one?
So I better wait till the mic is on. So you mentioned as one of the main challenges that not enough people are contributing, and maybe not contributing enough once they contribute. Now, one of the panelists, I think Susan Lund, mentioned earlier that in Australia they have a compulsory superannuation system. I myself, in a book I wrote when I was co-author when I was across the street, argue that we should have initially a voluntary scheme on top of Social Security, and maybe ultimately make it a compulsory scheme like Australia's. What's your judgment on that? Obviously, your clientele is probably saving more than the average and is a little bit different, but to make sure the rest of America is sort of better provided, would you actually favor a compulsory system, or maybe just favor something like secure choice that gives a push to people?
I think, Martin, it's a great question, and it's ultimately what I describe as a political economy judgment question about what works. Here in Washington, D.C., as you well know, if anyone uses the word mandate, folks run in the other direction. And so I think the wisdom of our democracy, for better or for worse, and it's both good and bad in obvious ways, is I think it's really hard to credibly argue that we should move to something that's compulsory. And we work a lot with the superannuation systems in Australia. It has worked quite well. There's no doubt that it has created a lot of retirement security in that country. I just don't think as a matter of judgment that we can actually, a political judgment, that we can actually get to a place in this day and age where a government mandate works. Not that it's a bad policy, I think it's just not practical politics, if you will. And so I think the better approaches are ones that are starting to emerge. Automatic escalations, enrollments where opt-out, for example, comes into play, right. Secure choice. Those seem to me, frankly, much more workable in the 2016 American context as opposed to trying to swing to the Australian superannuation model.
Well, let me just sort of follow up on that a little bit. We hear a lot about the shift to a new labor market. Uber is always the example that's cited. Some data suggests that that's still a small part of the economy, but it may be growing and it may be the wave of the future. Doesn't that raise the challenge there where you maybe don't have an employer, or you have a very different employer from one month to the next or 1 week to the next?
Oh, no, it absolutely does raise the challenge. The so-called gig economy was not what any of us were imagining, and it's starting to emerge. My view of that is, the fact that it raises the challenge doesn't mean that's impossible. It means that we have to start to do some new thinking. I have been in touch, for example, with a group called the Freelancers Union, probably not known at all in the space, maybe known to a few.
Yeah, I know.
And they are very much thinking about the possibility of creating products and services aimed at that population. My view, obviously, I think we all fully understand, it's the way free markets work. Where there is a clear demand, there will be supply. I think policy and the industry will come to grips with this large and growing number of, I would use the word freelancers, folks in the gig economy, and figure out what the solutions might be. The challenges will be, one, obviously, who is the plan sponsor, i.e. takes on the fiduciary responsibility to some degree. There are other challenges, though, around a very, very large number of likely small balance accounts. And then there is something I think can be easily resolved, which is literally just tracking people. Right. The tracking part is, I think, the easiest because we are no longer in a place where it's the stamp and the envelope. It's all about electronics, and so I think we can track people well. It's the first two that I think are going to be the issues. How do you deal with such a large number of small balance accounts where, by the way, the contributions are probably sporadic? And then the first one is, well, who sets up the plan? What do you enroll in? And how do you make it better? The final point I should say is one of the points that I made. I moved over it quickly, but it's very important, is also there's a question of how you provide meaningful advice to that population. Again, I'm pretty optimistic about the advice story. It won't be necessarily totally tailored to people, but with technology, with webinars, with phones, et cetera, and certainly iPhones and smart apps, it should be possible to get an element of advice. It may not be appropriately tailored, though, and that's the risk there.
I'm going to get some questions from the audience, but let me just ask you, and this may seem an odd question, but I was very struck in introducing you that you've had such an interesting career. You've been in a law firm, you've been at McKinsey, you've been at the Fed, and now you're president of TIAA-CREF. Of the things you did before you went to TIAA-CREF, did all of them help you in your current position, or is there some that you say you really, because it's such an interesting history you've had?
A checkered background.
A very impressive background.
You're awfully kind. The truth is, each one of them helped in lots of different ways. So starting life as a lawyer, if you end up in a place that's highly regulated, I am not, in any sense, the chief legal officer of this company, but being,
It's good to know the law.
But it's good to know a little bit about the law. And frankly, what's good about it is a little bit of poking and prodding is helpful. McKinsey, in terms of general management, problem solving, always useful set of skills. The Fed, obviously, thinking about markets, monetary policy. We have a very large fixed income portfolio. I am not the chief investment officer of the company at all, but certainly, a little sense of markets plays. So all of them have been really, really quite useful. Actually, the most useful thing was I spent between the age of 17 and 29 on a college campus. And so I'm...
Your education, yeah.
No, it's not just the education. It's actually spending the time understanding what higher education is like and the cultures in those campuses. So it's all worked. It's all worked to be very helpful.
Now, there was a question earlier about persistent low interest rates and the tendency to reach for yield. That must have been a challenge for TI Aircraft. Obviously, you've got a big equity portfolio, but you also have a big bond portfolio.
So it's been a little bit of a challenge, but not one that's all insurmountable. And so we certainly see, as the higher coupon fixed income investments mature and roll over, there's reinvestment into what will be lower yielding assets. But the thing that has given us a lot of very positive momentum, even in this low interest rate environment, is we have a very broadly diversified portfolio. And I don't think people think of us that way. They think of us as, gee, big fixed income and big equities.
Right.
The other big part of the company is around real estate, agriculture, timber, infrastructure, and alternatives, private equities. And I remind all of my colleagues, because we see it all the time, that a low interest rate environment is also a low default environment. It is an environment in which equities, not of late, but for long periods have gone through quite a rally.
Right.
And in which we think about our private equity portfolios, the cash flow generated there has been strong. And because we've been in agriculture, timber, and real estate for such a long period of time, as those investments mature, the cash flows from those and the ability to sell them at nice profits have played out. So the way that we've managed this is not by stretching for yield in the sense of taking more and more risk. It's really by putting together and leveraging a much more broadly diversified portfolio. Some things do well in low interest rate environment and others don't. And it has proven to be not the easiest of times whatsoever, but manageable.
Well, you've done well by my retirement, so I'm happy with that. Can we get some questions from the audience?
I think we should stop with that comment.
Yes, over there, and then Josh.
Yeah, Mr. Ferguson, this was a great presentation. One question, in your list of investments, you didn't mention venture capital. You talked about private equity. Does it include do you invest in venture capital funds to improve your returns?
We do some, but small amounts. And here is, again, where one thinks about the risk-reward trade-offs. Because of who we are and what we do, we tend to be slightly, I'd say, underweight venture capital because that is such almost a zero-sum game, if you will. So people get very excited about the so-called the things that really pay off. They ignore the large number of things that don't pay off. And so I think one has to be, while we have some, one has to be cautious in that space as opposed to putting a huge amount of weight on that particular asset class. Yes, the venture capital industry is moving. One other point I'd make, though, is one has to be really careful. I never demonize any asset class. I've been in and around markets since Josh and I were undergraduates together. If you've been watching markets for this long, you know that whatever was out of favor 10 years ago is going to be in favor 5 years hence. And since the companies that one wants to be associated with will have 100, 200, 300-year history, important to have a bit of exposure to everything because something will come back into favor. Something is already in favor, something goes out, something comes back in.
Josh.
Josh Cotton, Brookings. You talked about the importance of lifetime income, and one of the things that hits anyone who is looking at this is that the theoretical arguments for lifetime income do not match people's willingness to buy it, to purchase it. Right. And so my question is, you offer product offerings, you offer lifetime income as a default, you offer lifetime income as an alternative, et cetera. In order to actually get people to do this, does it have to be in the default, or are there ways to convince individuals to make a choice for lifetime income?
Well, first, like anything else, one of the things we know from behavioral economics is if you put it into the default, it does tend to work better. All right? And so we should recognize that. One of the things that we've seen is that it works well because people are buying or thinking about annuities, and with us buying annuity units almost from the very beginning. So they're accustomed to the notion that some of this money is going to be annuitized. It's not something that you suddenly discuss at the age of 59 and a half or whatever it may be. You think about it before then. Having said that, in order to make the lifetime income option work, again, I think you use the levers available from behavioral economics. So what are the things that are slowing people down around selecting the annuity option at the right time? One is how it's framed. There's an economist named Jeff Brown at the University of Illinois. He's done a lot of work on this. He happens to be on our board. And if you say to someone, are you willing to insure against the happy outcomes, you have a really good life, and you want to make sure you have income for many, many years, the answer is always yes. If you say to someone, are you willing to give some of your savings to an insurance company, and they'll give you an annuity contract back, the answer is no. Okay, so framing is important. The second thing is to build lifetime income products that really reflect and respect the concerns that people have. What are the concerns that people have? They have a concern that, I am in perfectly good health, I sign an annuity contract today, and I'm hit by a bus tomorrow. Highly unlikely outcome, but people have deep aversion around that particular outcome. So you develop, as we have, a product that has payment period certain. So whatever happens, someone will get a guaranteed income for a period of time. Check mark that concern. Third concern another concern that people have is, well, gee, it's not just me, but it's also my loved one. I'm the chief breadwinner, and so you develop, as we have years ago, a so-called two-life annuity, where we guarantee both lives. Third concern that people always have is around the so-called bequest motivation, which is, gee, if I give it all to you, I can't, support this charity or that charity. So, you explain how this should work. You make sure you don't annuitize everything. So what I'm suggesting, Josh, is you can still get annuitization done when it's the age 62, and it's the first time they've talked about it, if you create the options that respond to the natural concerns that individuals have. The final thing, obviously, is it falls upon the industry to create just basically more consumer-friendly products, right? So obviously everyone knows that the ones that I talk about really are. We have to be quite honest. One of the reasons that lifetime income / annuitization has gotten a less than positive name is there are some products that are sold by others that have not performed so well, hidden options, points that were being made on the panel earlier. And so the industry has to, police itself a bit better in terms of introducing products and services that can be made appealing. Consumers are not totally irrational when they, reject a product if, the product itself may not be the best thing for them.
Yes, question here.
Thank you. Sandy Apgar, pleasure to see you again.
Nice to see you.
Are there lessons for the retail investment sector from the 2008 election and this current election where very large numbers of individuals make very small contributions enabled by the electronics in their pockets, almost instant reactions to whatever may motivate them? And as we've listened this morning, and I'm not a specialist in this sector by any means, wonder if that phenomenon is, if you will, transferable, and how, if it is, it would be.
So obviously I can't answer from experience, but I can answer, my hypothesis is similar to the nature of your question, which is we know that in large part because of technology, individuals who may or may not be so engaged are willing to do what they think is right, i.e. support a candidate. Now, a couple of things that we observe. One is the folks who are giving probably do have a relatively high level of engagement. They get excited about candidate X, candidate Y, whatever it may be. Folks are generally not so engaged in their financial lives as they are in the passion of who they think is good for the country. So one challenge is to get that level of intimate engagement up so that people want to do these things. Second thing that I think we've observed from the success of these micro-giving kinds of campaigns is they're leveraging big data. So a clear understanding of you appeal to individual X around her or his specific hot button topic by saying your candidate feels strongly about it. And then you sort of go through the list of all the possible things that might appeal to one person or the other. So obviously the financial sector is working really hard on sort of big data and tailoring, et cetera. But that's one of the big lessons that I think one can learn from what's happening in the electoral space. The third is it's absolutely got to be mobile. We already know that. But if it's not working on an iPhone, an iPad, if you expect someone to be at their home computer or, heaven forfend, answering your phone, or even worse, opening mail, you are forgetting and not learning what we learned. Now, the industry overall is really well aware of being mobile. But I would say I've looked at, and we look at lots of industry websites. Most of them do not have the intuitive feel of what you see that most people are used to. We've recently redone ours, trying to leverage a lot of that understanding. You now scroll the way you do with a more modern app. The Uber look has become really important. The other thing that I think one learns is the app has got to be interactive. Something has to be happening. Again, similar to Uber, right? So if you look at what goes on in Uber, you order it and a name pops up and you can watch the little car coming and all that sort of exciting stuff. So it's the gamification of life, and it's not, I introduced Uber into the conversation. So there are a lot of behavioral tools that one can learn from both the fundraising apparatus and the get out the vote apparatus that has emerged in elections, plus other things that are really successful, and bring those appropriately into financial services. Obviously, this is a little bit of what robo-advisors do as well. So it's not as though this is not new. But what is new, I think, is really big companies, and others included, watching and learning very, very quickly. The other thing I think is important about this is we tend to associate all of this with millennials and young people. The truth of the matter is that's in no way are they the only ones who are influenced by this. And I think the financial services firms really need to understand, and we certainly do, that aging baby boomers, millennials, Gen X's, everyone is influenced by the same thing. It has just become ubiquitous, and it's not just a generational shift. One would be less relevant to almost any population if you don't give the capability of doing what we're learning is available through big campaigns, through fundraising, and through, let's say, the Uberization of the world. Does that make sense?
Well, I think that was, we got one more question up there. Gary Burtles, and retirement expert, so we better give him a chance to ask a question.
Well, we'll see if we want to give him a chance to ask the question.
Dr. Ferguson, the topic is equity markets, and one of the problems, I think, of the current defined contribution retirement space is that the workers who are owners of the nation's businesses through equity markets and through the retirement plans they have seem to have no voice at all in corporate elections. It's unfair to bring this to your attention because you offer a retirement option, social choice, right, which does permit people to exercise some degree of control over the companies that are purchased. But 99.9% of assets invested through the system. Vanguard never asked me how I think they should vote the shares. Fidelity never asked me how I should vote the shares.
We asked
Kraft really doesn't ask me how I should vote.
Well, yes and no, but okay. No, look.
And so it strikes me that if this is a form of people's capitalism, the people are left remarkably voiceless. And I kind of wonder what you think about that problem.
I think it's like Your question sort of hints about the way we work. I think it is a double-edged sword. Right? And so, yes, one of the reasons that we are one of the largest, sometimes measured as the largest, socially responsible, socially screened portfolio, is to give people a voice. There are certain kinds of companies they don't want to see their money invested in, and so we have come forward saying, you know, we won't invest in this or that. You will get a socially screened portfolio, et cetera, including low carbon and other things. So one is, yes, you know, the point you raised is one the industry should respond to. The flip side of it is two or three things. One is scale does matter. And I know even as we think about introducing new socially screened choices, how big is the demand for that going to be, right? So you and I may both say we are really socially responsible individuals, and yet your definition and mine might be quite different. So for a big institution, you know, you want to make sure you're not creating such a plethora of choices that what you end up with is a large number of really, really small funds where by definition the management expenses are high, and you have problems there. The other challenge that I think industry deals with in trying to respond to specific interests is the diversification issues that arise. You well know that one of the big diversification challenges has always been so-called home bias, right? We all tend to invest disproportionately in, particularly in the U.S., in U.S.-oriented equities. One of the great things about CREF is that it was structured to overcome that by having a disproportionately large, compared to most external exposures, which works really well for diversification. So I raise it to say you want to protect people a little bit from their preconceived notions of what's good for them, because they are, by definition, going to be cutting out some of the benefits of broad diversification, which one has to be careful of. And the final problem or challenge that one has to deal with in responding to specific individual concerns is transactions costs, you know, start to go up as you, again, start to shrink your portfolio, or the turnover might go up as companies change a little bit. So a prime example, I'm not putting this forward as the example, but a number of companies, Lowe's, the Lowe's Corporation, for example, used to be a really large owner of a tobacco company. Then suddenly they got rid of that. So are they now back in because mainly what they do is hotels? You know, it's, you get this question of how you define, and the transaction costs are moving from one to the other. So that's a long answer of saying, yes, we ought to offer, and we do, but others should as well, products that are responsive to the tailoring needs of individuals and the preferences of individuals, but one has to be careful, all of us, both you and we in the industry, how much of that you do, because you know, the difficulties of doing that for smaller and smaller groups are noticeable, and it's like everything else, therefore a trade-off. Shouldn't ignore the voice of the participant. We certainly listen closely, but also recognize that there may be a limit to how far you want to go, because that may not be in the long-term best interest of that individual even, as they change over time. I'm sure more to talk about here. I can tell from your body language that was not exactly completely, totally persuasive.
Well,
because it's not going to be an easy, totally persuasive answer to that very good question.
Well, I think we've taken a lot of your time, and you've been extremely informative and helpful. Thank you so much, Roger. We very much appreciate it.